Do you know how much you need in super and investments before you can retire? Is there an amount that you should be working towards? In this video, I'll explain how much you should be aiming towards so you can switch life of work for retirement, and I'll also go through 4 of the most effective strategies to help get you there faster, so you can spend more time doing the things that you enjoy, like practicing your golf swing, surfing, or maybe more time with family and friends, except for those in-laws who keep critiquing your cooking and DIY skills. I'm Chris Vlahos and I'm an authorised financial advisor with over 10 years of experience helping clients build and protect their wealth to achieve financial freedom. This video provides general information only and does not constitute financial advice, so please do read the description below. And of course, if you enjoy this video, please leave a like and subscribe to the channel. So, the Australian Superannuation Fund Association has done some research and found that in Australia, for a couple who owns their own home, to live a comfortable lifestyle, they would need to live off $73,031 per annum. A single person would need $51,814 per annum. This includes all living expenses and holidays of about $6,000 per annum. So based on these numbers, the Australian Superannuation Fund Association has calculated the amount you need in super to retire at age 67. And this is to live a comfortable lifestyle in retirement. And for a couple, that amount is $690,000. And for a single person, it is $595,000. Bear in mind, this assumes you don't have any other assets to provide you with an income and you're only relying on your super. It also calculates and factors in the age pension that you will receive along the way in retirement. But what if your living expenses were significantly more than this, which could be the case if you lived in a capital city like Sydney or Melbourne? A rule of thumb is people would use 70% of their pre-retirement income to assume they would maintain their lifestyle in retirement. So what if you needed, say, $100,000 each year or even $120,000? If your living expenses are $100,000 each year in retirement, you would need approximately $1 million in super. And if your living expenses are $120,000 each year in retirement, you would need $1.4 million in super. This assumes you invest in a traditional balanced investment option, returning 6% per annum. In the calculations, we've also assumed your expenses go up each year by inflation, and you live to age 87 based on the most recent age expectancy data. And what if you're someone who's younger in, say, your 20s, 30s or 40s, and you want to know how much you would need to have invested so that you can draw a passive income to replace some or if not all of your income? Well, you can use the rule of 25. The rule of 25 helps you calculate how much you would need to have invested to provide you with a desired amount of passive income. It assumes you invest in a balanced investment portfolio returning 6% per annum and you draw down 4% each year. For example, if you wanted to receive $50,000 each year in passive investment income, you would multiply $50,000 by 25 and that would give you $1.25 million that you would need to have invested in a balanced investment portfolio. If you wanted $100,000 each year of passive investment income, you would multiply $100,000 by 25 to give you $2.5 million that you would need in a balanced investment option. But keep in mind, for younger people who put money into super, you cannot access your super until you meet a condition of release, such as turning age 60 and ceasing a gainful employment arrangement, or even turning age 65. Or if you want to do the first home super saver scheme to assist you in putting a deposit towards a house, you would need to check the rules. I'll put a link in the description of this video explaining what the conditions of release are. So with this in mind, you may want to keep your investments in your own name rather than putting them into super, where you can't access it until later in life. So now that we know how much you need in super and investments to retire, let's go through 4 of the most effective strategies to help you get there faster. So the first strategy is probably one of the most obvious, but you need to be saving and regularly investing your income. Your ability to earn income is your biggest personal asset, but it means very little if you're spending every dollar. A simple approach that I like to use with my clients is to ensure that they maintain a cash reserve or an emergency fund to cover the next 3 to 6 months of their regular living expenses. They can then look to invest the remainder of their available cash and their income. By investing your spare available cash, it also removes the temptation for you to spend that money. The second most important strategy is to make sure that you're investing in the right type of assets, or what we like to call in financial planning, having the right asset allocation. Now, a lot of research has been done and has shown that at least 90% of your investment returns can be explained by the types of assets that you invest in. For investors with a longer time horizon, you should be considering what we call growth assets. So these mostly relate to shares and property. And for people who have a shorter time horizon, you should also consider increasing the amount you have in cash and fixed interest. So the more growth assets that you invest in, the higher the level of volatility you can expect, but also a higher return in the long run. If you've got a longer time horizon, you're able to allow your portfolio of investments to recover and bounce back from any declines in value. Whereas if you're wanting to draw down on your investments, by having more in defensive assets, your portfolio will not fall by as much during a share market decline. And this is the reason why we would encourage having more in defensive assets as your time horizon shortens. So let's look at the difference in returns over a 30-year period. Let's say you invested $10,000 in a balanced investment option returning 6%, or you invested $10,000 in a growth investment option returning 8% per annum. After 30 years, the balanced investment portfolio would be worth $50,000 and the growth investment portfolio would be worth approximately $100,000. A lot of this can be explained by compound interest by simply having a higher return on your investment, and also by reinvesting your dividends and distributions, you're able to achieve a much higher capital value at the end of the 30-year period. And now the third most effective strategy to help you build wealth faster and achieve your retirement number is by making voluntary and extra contributions to your super fund. This includes either salary sacrifice contributions or personal contributions to your super. Now, there are rules about how much you can put into super depending on your age, total super balance, and the amounts you've contributed to super in previous years, but I'll cover this in another video. Now, one of the main benefits of contributing to super is you can claim a personal tax deduction for the amounts that you put into super. The amounts that go into super are taxed at 15%, and this can be significantly less than what your personal marginal tax rate is.
Say, for example, a person earning $100,000 each year, their marginal tax rate would be 32%.
And this includes the Medicare levy. If they contributed, say, $10,000 to their super fund, this $10,000 will be taxed at 15% inside the super fund rather than at their 34% personal tax rate. And one of the other key benefits of super is when you retire, you can convert your super into a tax-free pension account. Now, you can access your super once you meet a condition of release, and it can be as early as age 60 and ceasing a gainful employment arrangement. Please refer to the conditions of release in the description below. And the final and fourth strategy to help you build wealth faster is by repaying your mortgage faster. The longer you keep your mortgage, the longer it's going to cost you in interest. So some of the things that you can consider are getting a loan with the lowest interest rate possible. So you'll need to shop around and try and negotiate with your bank. Unfortunately, banks don't reward loyalty, so you should shop around or even see a mortgage broker. Another thing you can consider is having a loan offset account to help lower your interest payments. And the other thing to consider is prioritizing your home mortgage repayments over an investment loan. Your mortgage is not tax deductible, whereas investment loan interest is tax deductible. So your mortgage is costing you more after you do your tax return. So let's crunch some numbers to see how much you can save in interest if you make extra loan repayments. Let's say you have a mortgage of $700,000, 30-year term at 6% interest. If you make $500 per month of extra loan repayments, you would pay your mortgage off 7 years faster and save interest of over $223,000. And instead of paying that in interest, you could be putting that towards your retirement savings. And the final thing to consider is you should consolidate your debts into the lowest interest loan, like your mortgage. Rather than paying 20% interest on a credit card debt, if you can put this into your mortgage, you would lower your interest to around 6% or whatever the prevailing rate is at the time, and that would provide you with quite a significant interest saving. So there you have it. Now you know how much you need to aim for to retire, and I've also given 4 of the most effective strategies to help get you there faster. If you're seeking advice to help you plan your retirement or build wealth, then please click on the link in the description below for a free consultation. And if you enjoyed this video, of course, leave a thumbs up. I'm Chris Vlahos, thanks for watching.